Hey everybody, welcome to this options training basic video. This specific video is geared towards beginners and offers an introduction to option trading, understanding on the mechanics of making profit using options instead of dealing with actual shares. As we go further into this topic, I will add more complexity, so please do study this video carefully. I'm hoping that after you watch this video, you will be as excited as I am about digging deeper into this fascinating topic. Please be sure to ask your questions as you proceed along this journey with me. And without further ado, welcome. Traditional way of making profit in the financial markets is buying shares when the price is low and selling them when the price is high. But what if I told you there is a financial instrument with limited risk that makes profit not just when the markets are going up, but also when the markets are going down and the markets are going sideways? More specifically, options allow you to build a long term plan that will help you use capital efficiently in the long term when markets typically go up. They will allow you to protect your portfolio and take advantage of volatility when everybody is panicking, which is when the markets are going down. Not just that, but they actually will allow you to create income when the markets are not doing anything and going sideways. So, the general takeaways: why options? Think about the fact that you can actually get paid to wait out to buy your favorite stock till the price of that stock is rightly placed. You could actually turn time into profit. Trading options, time becomes a valuable commodity. You could control 100 shares for a fraction of the price and not risking as much. Again, basically utilizing your capital efficiently. And last but not the least, option trading has a bad name that it's gambling. I want to assure you that in gambling, the house is always favored. During options trading, you can actually place trades in which the probabilities are working in your favor. This is a skill that once you learn it, you won't look at financial markets and investing the same way. So, without further ado, let's step into understanding the first basic options called call options, and the first strategy that allows you to take advantage of markets going up without buying the stock itself. Okay, to actually understand what options are, we are going to start with an analogy. So, suppose a friend's house is currently fairly priced at $100,000. Your friend is willing to write a contract in which you pay them $5,000 upfront, for which they will take the risk that their house will remain approximately at 100K and not substantially appreciate in the next 1 year. The key is 1 year. After 1 year, the contract is not valid. You yourself take the opposite risk that the price will substantially appreciate at least above 105K, which is basically 5,000 more than the fair value of the market. So keep that in mind for later. So, what does the contract say actually? You, the buyer, pays $5,000, which is referred to as the option premium, to your friend who's the seller. That contract grants you the right, but remember, it's not an obligation to fix the purchase price of the house at 100K. We are going to call that the strike price. Again, just to reiterate, it's a fixed price that you can purchase the house for the next 1 year, anytime you feel that it's favorable. So at that point, the house might be any price in the market. You get to purchase it for $100,000. And again, that is called strike price. So the takeaway of this is that you are in a debit of $5,000 and your friend receives a credit of $5,000. So let's talk about how you will make profit from this transaction or how you could lose money. So let's look at a scenario in which you will make money. Again, recollect that you have the right to buy the house at the fixed price, strike price of 100K. If the house goes up to 120K, what will you do? Step number one, you will basically buy the house according to the contract at the fixed price of 100K or the strike price, and you will simply sell that house in the current market at 120K. The profit from the step one and step two transaction is going to be the difference, which is 20,000. But remember, you had paid your friend the premium to get that right. So you subtract that premium and you make a profit of 15,000 from this. When will you lose money? So suppose the house doesn't change in market price or goes only up to 104,000. You will make a profit of $4,000 from the transaction. But again, remember, you paid the $5,000 premium already. So your loss is going to be $1,000. In other words, if you think about this, the house needs to be at least appreciating 105K or greater. Otherwise, you are going to be losing money. In other words, 105K is the break-even price. What's really important to note here is that your maximum loss in this contract is going to be limited to only $5,000, but your profit is theoretically unlimited. This is exactly vice versa for your friend. Their maximum profit is going to be what you paid them as the premium, but their maximum loss could be theoretically infinity. We have actually now covered some basic terms that apply to the options markets. So the current house price, which was $100,000, is analogous to what the stock price is. The contract that allowed you to buy the house at a fixed price, irrespective of whatever that current price of the market is called a strike price. In our case, we simply said it was going to be $100,000. But imagine there are multiple houses in the market which are also currently priced at 100,000, and they have different contracts with different strike prices. So there's no limit on them. They can be from 80,000, 90,000, all the way 110, 120, 30, etc. Same with the time of expiration. We said it's going to be 1 year, but really speaking, in the option market, the time of expiration will allow you to buy contracts right from 1 day, 2 days, 1 week, etc., all the way to 3 years. So these series of contracts that make the different strike prices and the different times of expiration is what makes an option chain. We call that a call option chain. So what I'm showing here is a simplified option chain, or basically a series of contracts at different strike prices and different periods of expiry. And to simplify, I have just done 4 different strike prices and 2 different expiry periods. Remember, in the options markets, actually, there's going to be many, many more strike prices and many, many more expiries. So what I want to illustrate here is how first and foremost, let's focus on the 1 year expiry and see how the contract price actually changes with the strike price. As you can see, it is inversely proportional to the strike price. So the house price again is 100K at that instant. As my strike price increases, my contract price is actually decreasing. So how do we explain this? And the answer really lies in risk factor. The more the risk perceived by your friend, the more he's going to price those contracts, and vice versa. So let's kind of look at that from that point of view to be able to understand. So let's look at this extreme case in which the strike price is 110K. So what your friend perceives is that in 1 year, for the house to appreciate from all the way from 100 to 100K, 110K is probably much less risk than actually the house, say, maybe appreciating to 102 or 105K. That means he will charge you less for that contract because the risk to him is less. Now think about from your point of view. For you to be able to make the profit, your house has to go all the way from 100 to 110K and even more. So basically, in this case, the break even price should be at least 112K in 1 year. And that likelihood is probably less likely than the house going to say 105 for you also. So you are not willing to pay too much for that scenario. And that's exactly kind of from both the sides, you can see why the contract is less price compared to, for example, a strike price of 100K. Let's look at the other extreme, and this is kind of interesting. Now, the strike price actually is lower than the house price. In this scenario, think about this from the simplistic approach. If really there was no contract price, you could have simply gone to the market and bought the house at the strike price of 95K and immediately sold it for the current price, which is 100K, and pocketed a profit of 5,000 immediately. But of course, there is no free money. So that contract price must have that 5K as well baked into it. And that's exactly why that contract price is, again, going higher and higher as you go lower and lower in the strike price. So that explains how the contract price varies with the strike price. Let's talk about how the contract price varies with the time to expiry. And as you can see, the contract price is now directly proportional to the time to expiry. In other words, the more the time, the more the contract. So again, focusing only on the 100K strike price. For a 6 months contract, the price is 3,000. For a 1 year contract, it is 5,000. And again, this is really about risk as well and probability. Think about the analogy to the insurance market now. For getting a fire insurance for, say, 1 month, it is going to cost much less than getting a fire insurance for the whole year. And that's exactly kind of what's going on here. For 6 months, doing a contract is going to be less costlier than 1 year. So buying and selling the house to make your profit is kind of tedious, a lot of paperwork involved, and just not feasible. Is there another way? And yes, there is. The answer lies in the contract price being dynamic. In other words, as the house price changes, the contract price itself is going to react to it. So currently, for simplicity, we are going to be focusing on when we buy the contract and when the contract is about to end in 1 year. So what happens in between adds another dimension totally and makes things interesting. So hold your thought till the next part of this lecture on that. For now, let's just focus on what's happening. In this case, if the house in 1 year goes to, say, 120,000, let's talk about the case where the strike price was 110. We already know how to calculate the profit and loss. What we do is we take the strike price, which is the price we will buy the house, and then we will sell it in the market at the current price after 1 year. So the profit and loss from that transaction is 10,000 minus the price you paid for the contract, which is 2,000. And that's exactly your profit and loss. And that's, by the way, exactly what the contract should be reflecting. In other words, simply add 8,000 to this 2,000 and your contract price after 1 year would have also gone up by 8,000. So now you could simply sell that contract for 10K. You bought it at 2K, selling it for 10K, making the same profit. Let's look at another scenario here. we know now that in this scenario, we will buy the house at 95,000 and sell it at 120. So from that transaction, our profit and loss is 25,000 minus 8,000, which we paid for the contract. So our profit is at 17K. Simply add that 17K to the contract price, and this is your new contract price at the end of 1 year. Because 25K is what you're selling, so you make a profit by 8K that you bought the contract, selling it at 25K. So, yep, that's basically how the contract prices move. And again, I'm going to repeat that this is at the end of expiry. If the house goes up to 120K in the next 1 month, something different is going to happen. You're not going to be realizing the entire profit of 8K, but something in between because there's a time component. And that's exactly where the option pricing models are going to come in. One last thing I want to point out is the maximum loss. And it is interesting to note here that the maximum loss will always occur at the end of expiry as long as the house price remains below or at the strike price. In other words, and we kind of know this already, if this house appreciated all the way to 109K, in spite of that, you are still going to see a maximum loss. In this case, again, it's pretty interesting. If the house remains at 100K, in fact, you're not going to be realizing the maximum loss. For maximum loss, the house actually now has to depreciate below 95K. So that's kind of how these option markets work. One thing it's kind of interesting, the profit and loss, it depends on the strike price. So you have a higher potential of making profit if you buy the option at a lower strike price. So that's kind of how these contract prices move. Really just the basic fundamental understanding. With this understanding, let's actually look at a simple profit and loss curve now. All right, so before I end this video, I would like to talk about risk graphs. These provide valuable tools to visualize how option prices move as time passes by, as stock prices move, etc. So here is a simplified example for our housing market. The x-axis of the graph is the house prices at expiry. This graph is specifically at the expiry. In the actual options market, there's going to be a lot of different curves which will represent different times after you buy the option. For now, let's keep it simple and only talk about expiry. So again, the x-axis is the house price at expiry. The y-axis is the profit and loss. So let's look at a few observations. First and foremost, this graph is at the $100,000 strike price and 1 year to expire example. What you can see here is that all the values of the house price below the strike price will give a maximum loss of 5,000. That's basically what we learned before. Your loss is always going to be limited to 5,000, and that's represented by this horizontal line. As the stock price starts, as the house price starts moving, your loss is going to be lesser and lesser. And in fact, your break even is going to be right at the 105,000 house price. Beyond that, you're going to start making profit. So for example, if the house price is 120, your profit is going to be at 120 minus 5, which is 115K. So that's basically how a graph looks like. One last point. So this is the graph for you as the buyer. The graph for a seller is going to be a mirror image around the x-axis. In fact, as you can see, his maximum profit is going to be limited to 5,000 as long as the house is below the strike price. And now he's going to start feeling the pain. First and foremost, the profit is going to start reducing. The profit is going to be zero right at the break even, and then start going into a loss almost 1-on-1. Again, for you, the maximum loss is 5,000. The maximum profit is theoretically infinity, and exactly vice versa for your friend. His maximum profit is going to be 5,000. His maximum loss could run theoretically to infinity. So with that thought, I will end this video, and I hope to see you folks in the next video where we take this simplified example and apply it to the stock markets and start looking at option pricing models and how time affects options, etc.